For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Why, sure. Welcome back. Podcast time. Johnny Dean, your podcast host. Professor Rick Plum, certified financial planner professional, accredited wealth management advisor, and that's all so far, but I'm expecting more accreditations for Rick Plum in the coming years, so stay tuned for that. Are you done? That's it, huh?
There has to be a good reason for me to take the tests.
Yeah, like somebody else has one and you don't have it.
Taking tests that much.
Yeah, it's no fun. Once you get to a certain age, you don't want to do it. No more classroom stuff. Well, anyway, we are here. Welcome back. It's nice to be here. I don't know when our season break is. Maybe we've had one already. These are planned well in advance. But I want to get right into today's thing. I got this thing, Rick, in the mail this past week. It's a big, colorful advertising piece. You know how those go. With the headline across the top, "Are you maximizing your investment returns in retirement?" Well,
is that the goal for one thing?
Well, here's where it got me. Below that, it says, if you're not, I don't know where they get this. If you're not earning at least 10% per year, then you must attend our free workshop in names the city. You'll learn how to maximize profits even when the market is down, which sounds like options, but I don't know. You'll learn how to create a hedge against inflation. You'll learn how to potentially double your returns through age 70 and beyond. Hey, at least they said potentially. I mean, at least somebody's got something. And it goes on from there. I'm not going to read anymore.
Wow. Did you at least get a free dinner, or would you at least get a free dinner if you attend this?
Yeah, it's at a I don't know if it's a steak place or something. I've never heard of this
well, at
place.
least you can get some free dinner. I mean, that'd be cool.
But yeah, I've had so many opportunities to attend these things. I haven't done one of these in at least 15 years, probably closer to 20. And but it did get my attention.
Well, it doesn't make sense. I mean,
well, no, it doesn't make any sense. So I thought I got to talk with Rick about this on the podcast. It got my attention not because I think any of it's going to work, but because, as you and I know, Rick, this is almost assuredly dangerous advice, which no matter what they're pitching or advising, I think will likely end disastrously for more than a few people who attempt it. Well, I'm not saying they won't get lucky.
It could work or it could not, and that is the problem. Because first off, the very first statement was maximize your return in retirement. Is my goal when I retire to maximize my return? Because to maximize my return, I have to step up the volatility. I have to accept risk. Am I willing to accept that risk? Especially if I need money from my portfolio. So, am I looking to maximize my return on a piece of my portfolio or my whole portfolio? Because my goal in retirement isn't to maximize. If that's the case, I'm going to Vegas. Let's be real. Or I'm buying lottery tickets because that's the maximum return I can get. It doesn't have a great probability of success, either one of those, but that's the way to really maximize your return.
Well, and at least maybe you'll get a free drink or something out of it in Las Vegas.
I can lose it faster than they can serve me, probably. So.
Well, that's probably true. But see, this is why, Rick, and you are right on track with me, and this is why I want to talk this week about this point that we've made on this program many times, which is that keeping money is a lot harder than making money, right? Okay? Yeah. It requires two completely different skill sets. So many strategies focus on how to grow money, but I think relatively few, are designed to help you keep that money, especially in retirement, or at least keep it without having to make major yearly changes or sacrifices based on the movements of the stock market. So I think you said you were talking about this very thing with somebody recently, were you not?
Oh, yeah. I was speaking it was a luncheon, a business group luncheon, and I was talking about what we do at Lucia Capital. And we were talking about there are lots of books, hundreds, thousands, maybe even millions. I don't know, but lots and lots of books on lots of different strategies, and they can all work. I'm not saying they don't, to grow and create net worth. But there's almost nothing written on How do you keep it? More importantly, how do you use it to your advantage when you're retired? Meaning, how do I get a stable cash flow from this wealth that I have been diligently creating? And the reality is, okay, there's two sides of this coin. There's the building of the portfolio, and there's the distribution of the portfolio to live on in retirement. That's generally the goal. And most people look at it's impossible to build wealth. Building wealth is not difficult. The hardest part, and I've said this many times, the hardest part about building a nest egg is having a big enough crowbar to get the wallet out of your pocket, and then another crowbar to get the money out of the wallet to be able to invest. You could be the best stock picker, the luckiest stock picker. You could know how to win the lottery. And if you don't actually put $1 or $2 into the lottery, I don't care if you pick the right numbers. You didn't have any skin in the game to win it. So you have to be able to put some money into something. Now, when it actually comes time to put money into investing, mutual funds, ETFs, whatever the case may be for this particular world, you don't have to pick the best, number one, best return of the last 1 year, 6 years, 8 years, 10 years, whatever. You just have to pick a growth fund. And even average growth funds, growth ETFs, the total market, the S&P 500, pick an ETF, pick a mutual fund, and start investing, because if you can't get started, you're never going to make a dime.
Well, that's true. And I want to point out, too, you mentioned the lottery. We are not saying buy lottery tickets. That is certainly not a...
Hey, if you want to buy a couple lottery tickets, I don't have a problem with that. But don't do it with the idea that that's my retirement plan.
That's where I was going with that. You're 100% on. And by the way, let's not forget, some people can make money just through sheer luck. They could win the lottery. They could have, Uncle Charlie dies and leaves them whatever amount of money. You could just happen to have a stock option that soars. I don't know, but a lot of that has to do with luck. But I know very few people, in fact, I don't know of any, Rick, that kept their money just by sheer luck.
Well, and you go back to the people that get rich, become wealthy by luck. If they continue to use that same strategy, they're not going to continue with luck. But we look at lottery winners, people that inherit money, people that have money just all of a sudden fall in their lap, lucky, whatever you want to call it. The odds 5 years later, the odds that they have that money 5 years later, 10 years later for that matter, are astronomically poor. If you don't have some discipline to build the ongoing savings, forget picking the right stocks, you're going to... It's very difficult to keep it because luck doesn't strike over and over and over and over. And you need to have a plan of action. The plan of action for creating wealth is to actually start saving. The best way to create wealth, besides being lucky or doing it the old-fashioned way by inheriting it, is to actually start saving. I love automatic enrollment in 401ks. Automatic escalators in 401ks. I think they're great because they take the decision out of your emotional hands, your procrastinating hands, and it happens. And the more it happens, the more automatic it is, the more you're going to save. We have lots of opportunities to save. Now, you hear the stats. Less than half the people have retirement plans, and so the government has to mandate that your company offers a retirement plan. I've told this story many years ago. A friend of mine said, "Why won't they give me more opportunity to save?" I said, "What do you mean more opportunity to save?" They said, "Well, I can only put X amount of dollars in my 401k." It's like, yeah, but you can still save on top of that. There's lots of ways to save. You can do IRAs, Roth IRAs. You can save personally. That's the hardest part is getting the money into the investments, not picking the investments. Well, but once you get it going, it works well.
I made a list here, just a quick list right before we went on. I have of 4 or 5 things skills that'll help you to build wealth. And when we say wealth, I'm not saying $500 million. I mean, I don't mean make you wealthy. I mean have a nest egg for you, something you could potentially live off of. But
having more than you have now,
right? Well, wealth is relative, of course. There are people who have who are don't make a whole lot of money that have plenty of wealth because they can get by on that. But building wealth, the skills I came up with were this. First of all, a willingness to take measured risk. By that I mean accepting volatility over the course of time, accepting that volatility happens and not being spooked by it. That's number one. Number two.
But you use the R word in there, and I try to not put those two words together. Using volatility to your advantage is not taking risk.
I understand that, and that's why I put measured risk in there. But I wanted to say immediately, except that volatility is in there.
Except for risk, volatility isn't risk.
No, it isn't. No, you're right.
Risk is being emotional or not planning properly and having to sell either because you're afraid or because you have a bill that has to be paid when the market's down. Your investments are down.
100% correct. All right. So, but you know what I mean. Let's accept volatility. Number 2 would be consistent saving and investing. If you don't save, as you said at the top of the show, then you're not going to have anything. I'm not talking about timing the market.
Okay, I was going to say, how many times have you talked or heard somebody say, "I haven't looked at my 401k in years," and the other day I got a statement. I opened it up, and I was like, "Wow, I got some money in there. Where'd that come from?"
It happens.
I've just been, putting money in every month, and I didn't even realize it, and it just happened.
So accepting volatility, consistent saving. The third thing would be have a long-term mindset. Let compounding work. Don't be chasing short-term wins and going for the gusto. You've already mentioned that. And then the fourth one was to be optimistic about the future. I think you need to be, but I'm talking about future 10 years from now, 15 years from now, that the markets and the economy will grow over a longer period of time. Those are the skills that I think people need. Now, I think you'd agree with those, but maybe you want to add a few more or comment on some of that.
Well, I do agree. And I think that the last one, that optimistic thing, people are very short-sighted in some respects. And let's just take this year. From the beginning of the year, that we've had a little turmoil, a lot of news, a lot of things that are maybe a little different than before, and the markets have reacted. And it's like, wow. And sometimes it's kind of hard to be optimistic, but that's all short-term. And it's weird because I remember looking back at it, one day, the news was positive on something and the market was up. And the next day, the news on it was negative and the market was down. And in reality, the issue that was happening hadn't changed at all for any one of those days. Nothing had happened other than the news reported that something may or may not be in the works. Not that it did happen, but that it may happen, and the market went up or down because of it. That's not fundamentally sound. That's going to happen. That's going to get whipsawed back and forth. We can't watch today's news and be able to. Unless you are a day trader and can manipulate very quickly and want to do that, and you're going to be wrong more than not. Using today's news is crazy.
Isn't that a bunch of people? But the ups and downs. Isn't that just a bunch of people trying to make short-term gains? I'm not getting off track here, but just my question is, isn't that a bunch of people saying, "Oh, look what happened today. I'm going to get out today. Oh, look, it changed. It went the other way. I'm going to jump back in." Isn't that what this is?
No raw data, perfect data to substantiate this, but I think a lot of it is computer trading. And then because of the computer trading, the average ignorant investor reacts on that after the negative has happened or whatever. So after it's already gone up, then they react, then they buy, which pushes it up more. And then after it sells off low, they sell off low. So they're buying high and selling low. Not a good way to create wealth. That's what that's that short-term mentality for 99.99998% of the people out there is going to get them in trouble.
So when building wealth, one of the skills is to ignore the short short-term noise, right? I mean, assume that whatever happens in the short term, a month, 6 months, 2 years, 3 years, 5 years in some cases, whatever happens in that shouldn't affect your investing philosophy. It shouldn't make you panic. You should just keep doing what you're doing and building that over time, knowing that over a long period of time, you should be okay. You would agree with that then?
Very much so. The time is your friend. Volatility, when you have time, is your friend. Dollar cost averaging, we talk about dollar cost averaging, and the reality is if you had a lump sum of money, should you dollar cost average into the market or should you just lump sum it in? Statistically, dollar cost averaging doesn't work as well as just investing. But most people don't have a lump sum to invest up front. They didn't win the lottery. They didn't inherit the money all in cash. We save, and we save on an ongoing basis. And that way, dollar cost averaging helps us. Just by sheer accident, we are going to be able to, if you are doing it systematically and automatically, we're going to take dollar cost averaging to our advantage. So volatility is our friend if we have time. Now, if I need to buy, we see people from time to time, I'm going to buy a house in 6 months, a year, and I've got this X amount of dollars available for my down payment, or I'm going to pay in cash, whatever you want to do. And it's going to be 6 months from now. Okay. Are you willing to buy 20% less house 6 months from now in the hopes that you can buy 20% more house 6 months from now? I like the idea of buying 20% more house, but I don't like the idea of buying 20% less house if I'm looking at buying a house. I mean, it's hard to deal with. So you can't be an investor on that particular issue because the time horizon is not your friend.
So let's take this now that we've talked about the skills, the important skills of building wealth, which is ignore what's going on in the short term because over the long term it's not going to matter. Use volatility for just keep pumping it in there. Volatility becomes your friend, especially as you just said, over long periods of time. And those are two of the most important things. Now let's flip this around. Let's talk about keeping wealth. We ignored the short term noise during the accumulation phase, right? I mean, who cares what happens in the next 2 years, 5 years? I don't care. What I care about is the long term.
There's always short-term noise. There's always. It changes. It's different noise, different frequency, but there's always short-term noise.
But you have to, when you build wealth, you're saying, I don't care. I mean, I'm in this for the long run. So I know this is going to happen. I'm just going to write it out. Now let's turn this around. On the distribution side, when I'm trying to keep this wealth, because I don't know how long I'm going to live, now the short term becomes the important thing, where it wasn't on the way up. Now that you're distributing it, short term is incredibly important, and we have to be prepared for it. We cannot ignore the short term. And how do we make sure that the short term is covered, Rick?
Yeah. Well, we look at the appropriate investments. And this is not a flip the switch one day, go from ignoring the noise. I was ignoring the noise yesterday, and I'm going to retire today. So now I have to start looking at or listening to the noise. No, this is a transition period where as we get close to changing our goal, the first goal is to create net worth, investable, distributable net worth in the future. The next goal is to start distributing cash flow from that net worth to support myself in my golden years, or for whatever it is, whether it's child's education or whatever the case may be. When we get close to that time period where we're going to change goals, we want to now start paying attention to the noise. Mm-hmm. And when we get to the retirement date, we want to have money set on the side that is not affected by the noise. And how much do we have there? We don't put it all there. We don't have to put 100% of our money into the noise canceling headphone set. We just have to have enough money in the lack of noise area to get us through the time horizon where noise doesn't matter.
Well, that's what I was referring to. where I could ignore the noise building wealth. Now I have to be paranoid about it. Paranoia is good in this sense because I've got to solve that problem first. I have to solve the short-term problem first. I have to make sure that my cash flow over the next week, month, year, 2 years, 5
6 years,
7 years is not affected by that. You see you know where I'm going with this, and a lot of our listeners already do too. But I'm trying to point out the difference between the two. It is 180 degrees the other way.
Right. And I would ask anybody out there, can you control the volatility of the market? Is there anything you can do to control the volatility? The answer is no. So you can't control the volatility, so that means we have to control how we invest to avoid the volatility so that we can count on the money. We can not worry about the noise. We have to buy time to ignore the noise.
Volatility becomes your enemy, which is an interesting thing to think about when it was your friend for 30, 40 years maybe while you were building wealth. Volatility in the short term becomes your nemesis.
But only for part of your money. That volatility is still your friend for some of the money, because if I'm 65, 70 years old, the money that I'm going to spend when I'm, a year or two from now, I don't want the volatility with. But the money I'm not going to spend until I'm 85, I don't care what happens to it tomorrow. I care what happens to it 15, 20 years from now. And so I can accept the volatility on money that I'm not going to touch for 15, 20 years. And that's why we identify the use of the dollars. The dollars I'm going to spend next year, I don't want to have volatility associated with it. And I'm going to give up some potential return to avoid some potential loss too. But the money I'm not going to need for 10, 15 years, I can afford some volatility. But you mentioned something earlier. When you're growing the money, compounding helps out tremendously. But the real difference between what I'm going to get as a return in over a 1 year period of time doesn't, if I get an 8% return, 10% return instead of a 4% return on CDs, it doesn't, in 1 year, it's not that big of a difference. Yes, it is a difference, but it's not a huge difference. It's such as if I were to get 8, 10% a year for 20 years versus 3 or 4% for 20 years. That's a big difference because compounding has had time to take effect and really grow upon itself and do things. But over a year or two, a short period of time, compounding does not have the ability to have a big impact on us yet. And so it's a matter of I'm willing to give up some return on my short-term assets to avoid that potential for a loss, because if you turn volatility into risk, and risk is real loss, that never recovers. And you're shooting yourself in the foot.
Compounding was explained to me. You can look at compounding almost like magic, because it's like watching a tree grow. Okay, you have a tree; it grows a little bit each year, but you don't really notice it. But if you walk away, you go away, and you come back in 20 years, assuming that tree is still there, you'll look at it and say, "Wow." I mean, this thing is huge. And so I think an apt comparison would be like that.
That's like a kid. I mean, the parents see him growing a little bit every day. They didn't see him to grow. But then you have an uncle or an aunt and uncle who hasn't seen him for 3 or 4 years. And they come in, holy cow, did you grow? Because they didn't see him. And we didn't notice. We knew they grew, but we saw it every day. It was just a little bit. And, but all of a sudden, boom.
Yeah, and you're there.
Kind of like what I call incrementalism. And we see this in politics and other things. Day to day, there's little bitty changes. And we don't feel it's the frog. The frog in the boiling water, the hot water. They don't notice it, and all of a sudden, you look back 5-10 minutes later, it's boiling. They're dead.
Well, you mentioned the not looking at the 401k. You haven't looked at it for 5 years or whatever it is, 10 years, and you come back and you say, "What in the world? How did this happen?" That's how that works. So if I make a list of things that you need, skills that you need on the distribution side, skills you need to keep your wealth, I would say, first of all, you need the ability to avoid catastrophic loss. Don't take risks that could damage your portfolio irretrievably, irreconcilably. That's the first one. The second one, you said it yourself. You need discipline and emotional control. Stay calm during downturns. How do you stay calm? Have the short term covered.
They work together. Having the cash flow in the non-volatile area to support your needs for the next 6, 7, 8, 10 years, whatever you feel comfortable with. 2 years, by the way, is not enough. Mm-hmm. That helps with the other side. That helps with the emotional control. Because
it's amazing how it all works together.
It's like, wow, I don't have to worry about it. Oh, that's interesting. The market was down. You look at what happened in March of this year. Just look back a month or two. March was ugly.
Yeah.
And then by the end of April, we were back at record highs.
But, again, even if we're not, even if it's all a charade, even if it's all smoke and mirrors and it all comes crashing down, you don't want to even have to worry about that. That's why we have that. And the third thing here is have a margin of safety. That's built-in buffers, that's your bucket one. You need to have flexibility in your plan. That's another skill to have, being able to adapt, when life changes and things like that.
And it does.
And it does. And the most important thing, separate your short-term needs from your long-term dollars.
This goes back to the adage of support your short-term liabilities, your short-term needs with short-term assets. Support your long-term liabilities, the spending that I'm going to do 15 years from now and later, with long-term assets. Match your assets and your liabilities, or match your liabilities to your assets. Which way you want to look at it, I don't care. But look, short-term, long-term, and never the twain shall meet. Because if you match your short-term assets with long-term, or short-term needs with long-term assets, sometimes it'll work fine, and sometimes it will not. Which are you going, and you have no control over which one. On the other hand, if you match your everything you have with short-term assets, unless you have a lot of assets, you're probably not going to keep pace with inflation and be able to continue spending. You're going to curtail your spending some point in the future. So you want to have the appropriate short-term, long-term, midterm, asset liability match system.
It's important for people to know this, and this is why we're talking about this today. Because really, first of all, keeping emotion out of it is a big thing. You talked about matching your assets to your liabilities. When I go back to the thing that we talked about here at the beginning, this little flyer that I got that made people think, well, gee, I'm retired. Maybe I'm 65, and how do I really need to double my wealth? I don't know. You tell me. Do you meet many or any retirees who are 65 years old or older and say, man, my biggest worry is that I won't triple my wealth over the next 15 years?
No, I have not met that individual yet. They say the biggest worry is that they run out of money. Mm-hmm. The biggest worry is that they can't retire when they want to retire. Mm-hmm. The biggest worry is that they won't be able to leave their kids something. And so we have to be able to figure out how to control the spending and all control what's the volatility or avoid the volatility. So no, I've never heard anybody say, you know what, I'm 65 years old now, and my biggest goal from here forward is to triple my money by the time I'm 75. Sorry, actually, if that's your goal, hey, more power to you. I don't know anybody in that range.
So why am I getting mailers like this? It to me, it's just a come on, people.
Well, they've got some trading system that they say is going, like they said, they hedge you in the downside. So who wouldn't want to get double the market returns with no downside? Can they tell me it's tax free as well? I mean, come on. I mean, who wouldn't want that? And because most people are not that savvy. I hate to say it that way. They're not. Math is just something that goes. If somebody tells me I can get better than expected rates of return with no risk, I want to hear, because they must have the secret formula.
No, nature does not like a cheat code, but
that's why you get those mailers.
That's right. There's a cost to everything. I mean, honestly, there's a cost. If you're going to do that, maybe you'll get lucky, but don't count on it. So really, we talk about this idea because at some point, the question stops being how much can I earn? How much can I make? And the question then becomes, how do I make sure I don't lose what I've already built? Too many people are not asking that question, and those are two completely different challenges. And I think if you don't look at it that way, if you keep using the same strategy or mindset that helped you accumulate your money, then you can end up taking risks that you don't need to take anymore. And that's where people get into trouble, especially in retirement, where there's no paycheck coming in and far fewer ways to correct and fix mistakes.
Well, doing what you were doing to build wealth and then just turning it around is a recipe for disaster, because now you're counting on volatility. Nope, it's not your friend. You're counting on time. Nope, it's not your friend. And so the systematic withdrawal is not your friend. It just doesn't work.
We've talked about all this. We know what we're referring to as the bucket strategy, and we don't need to explain it necessarily again. But I think people know who have been listening to this podcast know that that's what the bucket strategy is designed to address. All of these issues on the skill sets that are required to distribute your wealth. It's built around the idea of protecting what you've accumulated, giving you we hope, a reliable cash flow, and allowing the rest of your portfolio the time it needs to grow without forcing you to react to every move the market makes. Nobody wants to do that. You want to talk through how that might look in your own situation? Hey, reach out to the team, the advisors at Lucia Capital Group. Their phone number, 800-644-1150, 800-644-1150. Visit online, luciacap.com. I will spell it out as I always do, LUCIACAP.com. While you're there, hey, take a look at the guides we have available. The Bucket Strategy Guide is a very popular thing. We get probably more downloads of that than anything else. But there is a Bucket Strategy Guide there, Retirement Income Guide, which is part of that, Social Security Guide, Estate Planning, Rollovers. These are resources that kind of take you through these concepts in more detail. Just type in whatever you want in the search bar, and it should be the first thing that comes up. Don't forget to subscribe to the podcast, Apple Podcasts, Spotify, so you don't miss an episode. As always, we got more topics coming up that will help you make sense of all this and manage your financial future. Wow, hey, it all ties back, doesn't it? Amazing. Out of time. Thanks so much for listening. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I'm your podcast host, Johnny Dean. Thanks for listening. We'll talk to you all again next time. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested indirectly. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Before investing, carefully consider a mutual fund or exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.